But it's been written about, empirically stated, as well as statistically proven over and over again. Smaller niche funds are the better way to go across the board, and they're gaining momentum. Our host, Bronwyn Nielsen, spoke to Nersan Naidu, who's the CEO of Sanlam Multi-Manager International, and this was what he had to say about the growing trend of boutique funds.
One is to look at the broader themes that are playing out now and generally in the portfolio construction space. I think there's a couple of big things that are happening with the whole space in general, just in terms of what investors are going to be looking for from portfolios and from the way they construct portfolios compared to what they have done in the past. I think the first big thing is really that there's going to be a trend away from managers that are just there to provide different sources of alpha in the portfolio. I think what we're moving into now is an environment that's going to be a lot lower in terms of returns than we have seen in the past.
And that's what it is.
It's a low return environment.
Focus on performance, isn't it?
So if you look at, I think, the years from 1988 to 2000, we had, on a global basis, if you looked at a balanced portfolio with a 60-40 split between equities and bonds, you would have seen probably an annual compounded growth rate of about 10% per annum over that period. If you look at what's happened since 2000, and up to date, I think that same portfolio of a 60-40 split would have probably yielded around 5%. Now, what that actually means is that, in an environment where you've pretty much halved your annual growth rate, you're going to look at portfolio and portfolio construction in a different way. What we think is going to happen is that professional investors, pension funds, people who construct portfolios will start to look at the portfolio not just from a long-term strategic asset allocation basis, but will start to decompose the portfolio into its individual component parts and try to find investments that meet the specific objectives.
So this is obviously where the niche manager comes in. How do you differentiate? What is the definition of a niche manager?
So we would say that niche is a very specific word, but what you're actually looking for here is managers who have the ability to deliver high alpha. So as you said earlier, that's what it's all about now. We're in a low return environment. You want higher alpha. We believe that the niche managers have potentially a better ability to do that because of the type of investors who are going into that space. So you typically find it's seasoned investment professionals who've spent time in big corporates who now actually want to go into a space where they can express their own investment ideas more freely. They also tend to...
Is size a factor in this game?
Size is a factor.
Is small.
Niche is small, and the reason size is a factor is, as you know, there's been this well-publicized debate about the fact that in a market like ours, where the index has got roughly 160 stocks, as you get bigger and bigger in size, it becomes more difficult to take positions in the smaller cap end of the market, the small cap stocks, purely because your time to trade out of those counters becomes a lot longer, and taking meaningful positions in those counters becomes more difficult.
Is this going to be a definitive change in trend? Where does it leave the large asset managers?
I don't think it's going to be a complete shift away from the large managers. I think the large managers are always going to have a role in the portfolio, but I think they will have to become a lot more focused in where they compete and where their competitive advantage is in the overall asset management space. I think the mere fact that the environment has changed to one where it's a lot more low return, and that we will need to find managers who can produce high alpha, and when we say high alpha, I'm talking about tracking errors there in excess of 8% potentially, that you will tend to find those from managers who have smaller asset bases and a lot more focus in a capability.
But ultimately, you are going to provide a blended solution when it comes to choosing your asset managers.
Absolutely.
Do you have a particular bias? So beyond the focus on the niche managers, right now, what is your bias? Do you define value versus growth versus momentum?
No. So I think that is a more traditional way of looking at the portfolios, stylistically on that basis. What we think now, it's moving a lot more in the direction of focusing a little bit more on absolute performance. So looking at risk and performance more on an absolute basis instead of just a relative basis compared to benchmarks, firstly. And then secondly, focusing a lot more on uncorrelated sources of alpha, which has probably been traditionally a focus of the multi-managers, but when you actually start to break it down at the overall portfolio level now and across holistically asset classes, true multi-asset type investments, considering alternatives, property, the traditional asset classes, it's really a lot more now about finding uncorrelated sources of alpha and focusing a lot more on absolute performance.
While you're doing that, there's obviously still the value discussion, which is ongoing, and
Yes.
we know that the local fund managers in the value space have
Yes.
been under extreme pressure, and you bring in names here like John Bickard.
Yes.
What is your stance? You're going to stand through the value managers through this non-performing period? How long do you give them?
Yeah, that's always a tricky question. I think the rationale there has to really be around why you invested in those managers in the first place. Did you understand the risk, if I can call it that, of underperformance that you introduce to your portfolio when you choose to hire a value manager, and understand that when the market goes through cycles like this, where value managers are penalized because that's not the risk that's being rewarded in the market, that you can go through these cycles. If you take a long-term view and believe that through a complete market cycle these managers will actually recover, then you hold on to them.
But you must be able to mitigate against that risk with a blended portfolio.
Exactly. So by using managers that actually have sources of alpha that are uncorrelated to the value style, you actually minimize the impact of that underperformance from the value style in the overall portfolio. So that we would argue that's one of the benefits of constructing the portfolio on a multi-manager basis.
How big is your universe when it comes to the fund managers out there? It's only going to get bigger if you're going to start looking at these niche asset managers.
Yeah. It's easily in excess of 70 at the moment. So if you include the smaller managers, and if you break up the capabilities in the different houses now. So I think there's more unit trust listed than stocks these days, actually.
No, so let's talk now about emerging versus developed world. And a debate that's been on the table is the deceleration of the emerging markets, and that we're going to see this shift back to the developed world as their economies start to gain traction and their stock markets are offering better value. Where do you lie in that debate?
So on a valuation basis, we actually think that the developed markets, the emerging markets have been looking a bit expensive recently, but we have seen a sell-off on some of the emerging markets, following some of the geopolitical risks that we've seen in the markets in the last 2 to 3 months. Developed markets for a long time now we have seen as attractive on a valuation basis. We do think the emerging markets are also starting to look somewhat attractive on a valuation basis as well. In terms of a longer term trend and whether or not we're going to see a complete shift away from emerging markets back to developed markets, I personally don't think so.
It's still a long way off.
It's still a long way off. We're probably seeing a softer landing in a big emerging economy like a China than perhaps what some people were thinking about. Even though we are seeing some momentum coming back into the developed markets now, there are still headwinds. We've got
developed markets are hardly chasing the Chinese growth rate.
No.
So you can't not have emerging markets as part of the story going forward.
Absolutely not. We fundamentally don't believe that. And there are still headwinds to the developed markets. We are going to see a review of the US debt ceiling before the end of this month. That could pose some significant headwinds to developed markets in general.
Perhaps a buying opportunity into that developed environment.
Absolutely. But it's by no means, in our view, going to be a complete switch away from the emerging markets and back into the developed.
So the one discussion is developed versus emerging. The other discussion is offshore versus onshore from an equity perspective.
Yes.
And we know the JSE is looking expensive. There are pockets of value, resources come to the fore in that discussion.
Yes.
Just your overall stance on offshore versus onshore and where you are in that discussion.
Okay. We think the local equity market is priced expensively at the moment. So when we look at equities as an asset class, we would prefer to be overweight equities at this point in time, but favoring international equities a lot more than domestic. We think the valuations on the domestic market are a little bit stretched, but as you correctly pointed out, within that overall picture, there are certainly pockets of value within that. Our position now is to be neutral on domestic equities because we think you could have a situation depending on what happens with the global economic recovery. The resource counters still have the potential for earnings to come through there. Those counters I think are looking at earnings which are 30 to 40% off year on year. If earnings does come through on the resource counters, then you should start to see the valuations on the domestic market start to look a lot more attractive. We might then start to favor upping our weightings there, but for now we are neutral on domestic equities.
And overweight international equities.
Overweight international equities.
Where specifically, from a geography perspective, are you playing more in the European space, or are you farming the US?
No, we're investing in a geographically diversified portfolio of investments, which is skewed towards developed economies at this point in time. We might start to take that weighting back towards emerging markets, within the next couple of months.
No, so just coming back to what you do on a day-to-day basis, and obviously that is a lot has to do with analysing the fund management environment and then allocating funds. What is the biggest challenge you face in doing that?
In looking at the managers now, I think the question is really where is it that you can add the most value to your investors from the skills that we bring to the table. If you talk to equity analysts, they're sitting out there researching the stocks on the market, those counters, and trying to determine where there's most value to invest client money in. Our job is really to look at the universe of fund managers that are out there and determine where the skillful managers sit. So fund management is a game of both luck and skill, and those managers that have true skill are the ones you want to invest with over the long term, the ones you'll want to stick with through cycles of underperformance, because you inherently believe that their skill will come through. So the challenge for us is really to try and identify those managers with true skill and to figure out where our research expertise and skills would be best deployed. Coming back to the earlier theme, we believe now that the value add that we can bring to invest our client portfolios through our research expertise is actually more in the smaller manager space, the lesser known managers, than in the big manager space. What
is working for you? Is there an example of what has worked really well in the niche management space?
There are a couple of managers who are doing exceptionally well now. One of the managers that we identified a while back, which we think is coming up through the ranks quite nicely, particularly on the institutional side, is First Avenue Investment Managers in Johannesburg.
And the team.
Shelo, a great business. So there are managers like that which are coming through the ranks, which find investments in our portfolios, and we think on a 10-year view, those are the kind of managers that we would want to identify.